Hey, here's what I'm going to really be talking about tonight. Some of you have never met me before. Many of you have, but I'm going to give a really quick intro about my background and my experiences, and so that you could have a better appreciation for my insights and the things that I'm about to share with you tonight. And then I'm going to quickly recap 2023. I want to talk a little bit about market cycles, and I'm going to give you some feedback and some insights into where I think we are in the current market cycle. I'm going to take a quick look at multifamily versus other commercial real estate and how it's performing. And then I'm going to dive right into what I see for the 2024 investment environment. And then finally, one of the things that people love to hear and see from me is what are my top markets for the year. And I'll be doing that. So a little bit about our company. Our company was formed in 2013. And, we've come a long way. We've been in business for over a decade. And that says a lot about us. They say that 95% of businesses fail within the first 5 years. And then the next 5 years, they say another 95% of them fail. So to get to 10 years, you're in like the 0.4% is a statistic that I read, like 0.4% of companies stay in business for that long. And the way we've done it is we serve our clients and we teach people and we help people. And if you look at our mission, this is exactly what we do. We mentor people to achieve financial freedom. And the way we do that is by investing in apartments. And the reason is that's how I achieved financial freedom. I invested in apartments. My first apartment building was in 2002. It was 32 units. And I started with no previous investing experience. I have an engineering degree and an MBA. And that was my first investment property I ever did. I didn't buy a single family home, a fourplex, an eightplex, a 16 unit. I went for 32 units. And then I did another 30. And then my third deal was a 250 unit that I syndicated, which is a fancy term for using other people's money. And I quickly learned about economies of scale. So this is what we do. This is what me and my team does, is we mentor and coach a lot of people, but even the people that we don't directly mentor and coach, like some of you tonight, we hope to make an impact. I hope to inspire you, to motivate you, to get you excited about multifamily. And whether you do it with me or somebody else or on your own, if I can move you into that direction, then I'm going to consider that a successful engagement. So we're here to make a big impact. And a couple of years ago, I said, hey, we want to impact over 1 million people to get financially free by investing in apartments, following a proven system that I've been doing for 22 years. And some of that system is going to be revealed tonight when I talk about market selection and what makes a good market. And we're not just doing this for ourselves or our investors. We're doing it to impact communities. And most of the properties that we buy, with some exceptions, but most of the properties that we buy are workforce housing, the Class B, the Class C properties, families making 40, 50, 60,000 a year, hardworking American families. And so we provide them a clean, functional, safe product. And we're able to consistently, more often than not, generate positive returns for us and our investors. So that's what we do. That's what we've been doing. And that's what we're going to continue to be doing. So a little bit about me personally. I already shared some of this. My first investment property ever was a 32-unit apartment building. I started in Houston, Texas. This property was in Pasadena, Texas. Is there anybody here tonight from Houston, Texas? If you're from Houston, give me a shout out and type in Houston. Let's see, who's all from Houston? Okay, I see Jade. I see, here I am. I'm in presenter mode. Thank you. A lot of you in Houston. Scott, Mo, Chris, Houston baby, Raul. Lots of Houston folks. I loved Houston. I lived in Houston for 19 years. So my first 3 properties were actually in Houston, specifically Pasadena, Texas. My 32 unit, my 30 unit, my 30 unit, my 32 unit, and my 252 unit were all in Pasadena, Texas. Now, over the last 2 decades, it's actually been 22 years, I've owned 57 apartment buildings, over 10,000 units. Now, when I say I owned, I've invested in and I've led. And most of these deals, I'm a general partner. So, you know, and a lot of times you'll hear people say, oh, I own 5,000 units. Well, most of those people don't actually own 100% of 5,000 units. They're a general partner or a lead syndicator or a managing partner. So they have ownership interest, and many times they have management, decision-making, participation, and authority. Okay, so just to clarify that, when you hear people talk about how many units they own or how many assets they have under management, okay, it's usually in partnerships, not as an individual. And those units that I've invested in and have management responsibility for total over $1 billion of assets, and 21 of them have went full cycle, meaning I've sold them and made a profit on each and every one of those that I've bought and sold. Now, I still have, what's the math, 36 properties right now, okay? And those properties are still in the cycle, meaning I bought them, we've improved them, we're holding them. Some of them are performing great. Some of them have some challenges, just like some of you. But the intention is to continue the business cycle, get through the market cycle that we're in, and exit these properties profitably. And that's the plan, okay? And because of the tremendous tax benefits to owning apartment buildings, I've paid 0 in federal tax 2018 through 2022. Now, we just finished the 2023. 2023, it looks like I'm going to owe some taxes. And I'm not excited to share that, but I sold 2 properties and have capital gains. And so capital gains tax are taxed at 20%, not 37%. But it does look like I'm going to have some capital gains taxes in 2023. So I won't be able to make that claim this year. Now, in 2006 is when I started mentoring other people. So the first person I was able to help become financially free was myself. And then I started coaching and teaching and guiding and mentoring others. And since 2013, when I started my own education platform, my students have absolutely crushed it. They've purchased probably more than this. I used to track every transaction, but my students have purchased over 750 apartment buildings, over 100,000 units, and over $6 billion of multifamily properties across the United States. And hundreds of them, literally hundreds, have increased their net worth by over $1 million. Okay, so that's a little bit about me. Now, let's move quickly into a recap of 2023. Okay, so 2023, and I'll cover a little bit of 2022 as well, but just to give you all some perspective, the interest rate hikes that happened in 2022 and 2023, it was the fastest in history. Okay, history, not just in the last decade, but in history. Okay, so what I'm trying to say is the experts never saw this before. You know, most of us never saw it before. And I don't want to argue or debate about how it was created, but, you know, we had the pandemic, we had massive unemployment. And then in a short period of time, we had 2/3 of those people back to work, but working from home, and people were paid to stay at home. And throughout that time, we were concerned. I was an apartment owner back then. Of course I was. I was concerned, like so many others, that nobody was going to pay the rent. We've heard about, remember those talks about evictions, moratoriums, rent strikes. Nobody has to pay the rent. You can't evict people if they don't pay the rent. Well, in most of the markets that me and my community have invested in, which are more landlord and business friendly environments, add into the fact that the government paid people, whether they were working or not, they were paying people to stay at home and not work during the pandemic. So most people paid their rent. Okay. Now there were a few percentage points that didn't, but most people by and large paid their rent. And so all those talks about nobody paying rent for the most part didn't happen. And then of course it created inflation and rents went through the roof and property values skyrocketed, and then taxes caught up to those values, and insurance, went up tremendously because of weather incidents. One of the reasons, that happened in a lot of the markets. And so it's been a challenge, and interest rates went up, and getting new debt for acquisitions became very difficult. Lenders tightened up. Interest rates were hovering, it's mid 6-7% at one point for fixed rate debt. The values that sellers were used to getting was up here, and what buyers wanted to pay was down here. Very few transactions happened in 2023. Like the transaction volume, meaning the purchase price, the cumulative purchase price of the deals that actually traded hands from one ownership group to another in 2023 was the lowest since 2014. Okay, it was the lowest since 2014. And many of you haven't been in real estate or apartments since 2014. So most of you never saw anything like that. Okay, now I did, because I went through the last great financial crisis where doing deals was tough. But 2023 was a year where it was like getting debt was tough. The LTVs are low. The interest rates were high. There was a big gap between what sellers thought their properties were worth and what buyers were willing to pay. So sellers that didn't need to sell, they didn't sell. Does that make sense? They didn't sell. They don't need to sell. And buyers weren't willing to pay the price because the debt was too expensive. So there weren't a lot of transactions. Okay, there were not a lot of transactions happening. Lowest since 2014. So in the meantime, those that were doing deals had to battle against, negativity. Maybe they've heard about, some people getting into deals in 2021 and 2022. They've heard about capital calls. They've heard about distressed deals. So there's been some negative press about multifamily. And so not only was it hard for buyers and sellers to agree on a price, it was hard for investors to raise capital. So what used to be easy became hard. Okay. So it was a challenging year, to say the least. Now let's look at some of the things that actually happened. And I pulled together a lot of my data from different industry reports and stuff like that. So if we look over the last 12 months, there were 570,000 units that came online, but only 331,000 of those units were absorbed, meaning they were rented. And so what that did is it created more vacancy. And so if you look at some of the ovals that I have highlighted, one of them down in the bottom right, just a few years ago, vacancy was 4.8% nationally, and it's crept up to 7.2%. Okay, at the third quarter, and ended the year 7.6%. Now, rent growth, many people heard was negative, but rent growth nationally is still positive. It just the rate of rent growth has went down. So instead of seeing like 3 or 4% rent growth, or 2 or 3 or 4% rent growth nationally, which we were used to seeing, we saw that slow down. Okay, down to 0.8%. And in some markets, it's actually negative. If you look down in the lower left corner, markets like Austin and Atlanta have rent growth of like -3%, -4%, okay, because they had too many new units coming online relative to their total stock of apartments. Now, the interesting thing about new units coming online is most of these units, but not all, are Class A. And so when you have all these new Class A units coming on from new construction, people that own Class A, they're going to have more vacancy, and they're going to have more concessions. So we actually saw a weakening in performance in Class A, okay, because of all the new inventory that came online. Now, the Sumrok bread and butter deal has never been a Class A. I mean, we've done some Class A's. I've done one or two. My students have done some of them. But our bread and butter deal, if getting back to the basic fundamentals of when I started this company, we were doing Class B and C. And the majority of our students and the majority of the deals that we evaluate, the majority of the brokers that we that we deal with, they handle and specialize in handling Class B and C buildings, okay? So these are national numbers across all asset classes, across all geographies. Now, if we look at some of these statistics, okay, vacancy rates, 4- and 5-star property is CoStar's language for Class A, 3-star is their language for Class B, and 1- and 2-star is their language for Class C. So we could see right now that the national vacancy rate is 7.6, but it's 10.3 in Class A, 7 in Class B, and 5.5 in Class C. And I could speak to that because I'm in investments of Class A, B, and C, and my C-class properties have much lower vacancies than the A's. And I'm going to do Q&A at the end. Okay, otherwise this will go on all night. So hopefully let me get through everything. So if we look at the forecast, though, the forecast is a future looking. We're looking at vacancy to be 7.3 this year. So it's currently 7.6. And so we're looking at that vacancy number to start ticking down. Okay. If we look at delivered units, it's going to go down from, 500,000 to 350. So there's less new units coming online. And there's going to be more units absorbed so that the number of units coming online versus the number of units that's going to be rented is close to balancing. And we're going to be back into positive rent growth, according to this forecast, where we're going to see rent growth in the 3% range nationally going forward across, and these are national numbers across all geographies, across all property classes. Okay. So forecast things are turning around. Now, this dashboard shows some KPIs of where we finished a year compared to historicals. So the first thing I'm looking at is the price per unit. So the green is the current price per unit of $226,000. And the gray was last year's number at $238,000. So we could see the price per unit came down. The next one is cap rate. We could see that last year's cap rate was 5.49 and now it's 5.9. So cap rate went up. That makes sense. Price goes down, cap rate goes up. The 12-month sales volume, this is what I was talking about. Last year, there was 193 billion with a B. $193 billion of transactions. This year, it was 81. And that blue range, by the way, is where most years fall in. And you can see this year, that 81 billion is not even in the blue range. It was lower than it was over in a decade. Now, same when we look at the occupancy. Last year's occupancy was 93. Now we're at 92, and that's outside of that blue range. The absorption. 1 year ago, only 147,000 units were absorbed. And this year it was 331,000. And then if we look at the last one, the number of units delivered, last year it was 567, or this year, and last year it was 479. So there was so many new units coming online in Class A that created a lot of vacancy. So that's kind of how we finished up the year. Okay. So in summary, for 2023, we had investment activity taper off to levels that we haven't seen since 2014. Transactions, the number of transactions have decreased by 70%. 70. That's huge. Okay. So if you're in the business and you've been looking for a deal and you didn't get one, well, I hate to say it, but neither did a lot of other people. And just to put some things into perspective, In 2021 and 2022, I did 7 deals and 8 deals. In 2023, I did 2. And they both came, one came in September and one came in December. And I want to make sure I said the right year. 2023, I did 2 deals, one in September, one in December. 2022 and 2021, I did 7 or 8 each year. Okay. So not a lot of transactions. And why? Again, I explained why. Gap between buyers and sellers, pricing expectations, difficulty raising capital, difficulty getting affordable debt. Okay. Now, if we look at the other summary, here's where the opportunity is. Okay. Prices are down 20% nationally. In some markets more. I've seen pricing down 30%. Now, they're saying here that in Class A, pricing is down 20%. In Class B, they're down around 15%. But what I've experienced in the markets and the deals that I'm looking at is I'm seeing pricing anywhere from 10 to 30% below where it was in 2022, 10 to 30%. Okay, so that's an opportunity for those that are ready for it. Now, if we look at the capital markets, again, if you look at what I've circled here in red, if we look at the bottom left, prior to 2023, we were used to 70 to 80% loans, and we were getting debt at 3 to 3.5%. And then we saw loans at 50 to 60% in the 5s and the 6s, and sometimes even close to 7%. Okay. So that, again, I spoke about that. And so we've seen cap rates go up. If we look over to the right column, cap rates are roughly in the mid 5% range for Class A. And when we get into the Bs, they're approaching 6. And when we get into the Cs, oftentimes they're at 6 or even higher. Okay. So we've seen movement, upward movement in cap rates. Okay. Now, the next thing I've circled was talk about the amount of debt that's expiring. And so we have billions, hundreds of billions of dollars of debt that's coming due in 2024 and 2025. And we've seen some in 2023, but there's going to be more in 24 and 25. But what we haven't seen yet is big spikes in distressed deals because of these debts coming due. And I'm going to talk about that. Well, let me key you in on it. The FDIC has been encouraging banks to work with borrowers on loan modifications. So borrowers, banks are getting pressure from government institutions to work things out. No, I'm not saying that it's a guarantee. I'm not going to say it's going to happen in every case. I'm not going to say there's not going to be foreclosures. All I'm saying is what I'm going to report to you from the data that I've said is that there's a encouragement happening from government agencies to work with borrowers on their loans. Okay. And that's one of the reasons we haven't seen lots of distressed deals hitting the market, or at least as much as was once speculated. Okay. So the next thing I want to talk about a little bit is market cycles. And some of these slides I actually pulled from an investment conference I attended in Houston. And believe it or not, it was not a multifamily investment conference. It was an alternative investment conference. And I like to attend these from time to time because I'm a student. I like to learn. And I'm heavy into multifamily, very, very heavy. But I do like to learn and experience and expose my brain to other alternative investments. Okay. And so I attended an alternative investment conference, and they talked a lot about market cycles. And I had some interesting perspectives I'm going to share with you. But this slide here isn't from that. I was talking to a friend of mine in the brokerage business, and he said, Brad, imagine the market cycle was like a clock, 12, like a round clock. And we talked about where we thought we were in the cycle. And obviously, if you could time things perfectly, which we can never do, by the way, but if we could time things perfectly, we'd only buy when it's 6 o'clock, and we'd only sell when it's 12 o'clock, right? Y'all agree with me when I'm saying if you could time everything perfectly, which we know we can't do, how many people would buy at 6 o'clock? If you would buy at 6 o'clock, type in 6 o'clock. Type it in the chat, 6 o'clock. Yeah. And if you could sell at 12 o'clock, how many of you would sell at 12 o'clock? How many of you would sell at 12? Type in 12 if you'd sell at 12 o'clock. Yeah, but here's the challenge. You don't know. Okay, you don't know. And nobody knows. Nobody here knows. I don't know. I'm going to give you what I believe to be true based on my studies, my experience, my 22 years, but nobody knows for sure. Okay, nobody knows. Okay. And so my question to you is this: where do you think we're at in the market cycle? What time on the clock do you think we're at? And I want you to go ahead and type in a number. Okay, I see a 7. I see an 11, 6:30, 6, 4, 5, 5:30, 5, 3, 3, 5, 5, 5:30, 6, 6, 6, 5, 7. Yeah, let me tell you where I think we're at. I think we're past 4. How many people think we're past 4? If you think we're past 4, type in past 4. And how many people think we're not yet at 8 o'clock? Type in not yet 8 if you think we're not yet at 8. Okay, so the majority of you that are participating believe that we're somewhere between 4 and 8. Well, I'm going to take it a step further. I think we're somewhere between 5 and 7. I don't know for sure. Don't take my word for it. But the question is, if you knew that everyone would buy at 6 and sell at 12, but what if we're at 5? And see, some of you this is where you may, well, it's up to you to decide, but some of you at 5 or say, hey, I'm going to wait to 6. But the thing is, you don't know if it's 5 or you don't know if it's 6. Okay? Because you can see 6 says falling real estate prices. 5 says tighter money. 7 says falling interest rates. So today, the Fed had their meeting and they kept interest rates the same. They did not lower interest rates. And they didn't guarantee they're going to lower them in March. But I think we're somewhere between 5 and 7. And what's going to happen is when those rates start lowering, there's going to be a lot of people that are going to want to jump in, and they still may get in on time. Look, it's all like, look, if you could buy at 7, it's good. If you could buy at 8, it's good. Okay. So there's nothing wrong with it. It's just that if you could buy at 5, 6, or 7, it's better than buying at 8. So I believe that we're somewhere between 5 and 7. Okay. So the next slide, maybe some of you have seen some of these terms, and I'm going to go a little faster here because this stuff excites me so much, but I have a lot of content. We could see some of the emotions that happen when we're at the top of the market versus we're at the bottom. So again, like, what emotions are most people experiencing? You know, panic, desperation, fear, capitulation, just get me out of the deal, depression. Like, we're somewhere there. Guys and gals, we're somewhere there. Okay, we're in that 5, 6, 7 clock position, I believe. Now, this is from John Templeton. He says, the time of maximum pessimism is the best time to buy. So when everybody's saying it's a bad time, it actually might be a good time. And when everyone's saying it's a great time, it might actually be a bad time. And I could also say this, look, I bought deals in 2008 at the top of the market, and I got through it. It wasn't easy. I had to hold them longer. They didn't always hit the projections, but I got through it and got people money and made profit, not as much as I projected. And then I got into deals that completely outperformed everything I ever projected. Okay. So, you know, the market always cycles. That's something that people want to understand. Now, this is from Howard Marks, who's a billionaire. This is his way of market cycles. Starts off with rate cuts, bringing in easy money and positive developments. It reduces returns, leads to a willingness to bear increased risk to get higher returns. It results in unwise decisions and some investment losses. And then it brings in a period of fear, tight money, and contraction, which is highlighted, by the way, because that's where this presenter believes we are, which leads back to step one: rate cuts, easy money, and positive market developments. Okay. So let me show you an example. If we could buy a deal that's worth $1 for $1, okay, and we have an annual growth rate and we hold it for 5 years and we sell it at $2, it shows how we 2x our money. And that, by the way, for over a decade, one of the things I've been teaching is if we could find a deal that doubles investors' money in 5 years, it's a good deal. That's my threshold for a good deal. Double money in 5 years. Many of you in my mentoring programs know that. Okay. And this slide's not even for apartments. This is for, you know, anything. Now, the next row shows we buy a deal worth $1, but we're in a period of, you know, easy money and lots of activity and lots of interest and lots of competition. And so we pay $1.30 for that asset that's really only worth $1. Well, you could still get a profit on that deal, but instead of a 2x return, you may get a 1.55x return. Instead of a 15% IRR, you may get a 9% IRR. That's where I believe in hindsight, that's where I believe we were the last year. Okay. There's some challenging deals. And again, some people unfortunately may lose some money, but I think a lot of deals with the right funding and leadership and management and decision-making and teamwork can get through this cycle and come out the other side. I've done it in 2008, 9, and 10. Okay. And so we could still get positive returns. It just might be lower than what we had projected. Now, on the other side of the coin, if you buy at the 5 o'clock, 6 o'clock, or 7 o'clock position, and you buy a deal worth $1 and you get it for 70 cents, now you got that 2.87 return and a 23% IRR. So this is where I see us heading. Again, are we at 4 o'clock, 4:30? I think we're past 4. I think we're at 5, maybe past 5. I think we're in that 5, 6, 7 position on the clock. Okay. But what that means is, and what's occurring for me is there's opportunity. Okay. Now the next slide pretty much shows the same thing. So I just skip over this one. So commercial real estate, where do apartments stand up to other commercial real estate? Well, if we look at apartment vacancy and we compare it to retail, right now it's about the same as retail. Although over the past few years, it performed much better than retail, and now it's about the same. It's way better than office. It's about the same or a little lower than industrial, and it's much better than self-storage right now in terms of vacancy. Okay. And hotels, by the way. So apartments are certainly performing better in terms of vacancy than most other commercial real estate. Now, the chart I'm looking at here is rent growth. Again, outside of industrial, the rent growth we've seen in apartments up until the third quarter of last year is better than office, storage, retail, and hotels. Okay, so outside of industrial, apartments are outperforming in rent growth and top performing in vacancy. And if we look at these charts, these are delinquencies. Okay, again, besides industrial, multifamily delinquencies are lower than most other forms of commercial real estate, and they're well below 2%, well below 2% delinquencies. Okay. So apartments, for those of you that are considering or have considered other commercial real estate investments, and I talked about this in the past, it's not part of my presentation tonight, but apartments, nothing is 100% recession proof, but apartments are recession resistant. And especially what's happened with single family housing prices over the past few years, where it's an all-time unaffordability, it's driving more and more people to stay renters and to rent instead of buying homes. Okay. So this is what I said before, and this is coming, I pulled this directly from a report. The FDIC guidance is giving guidance to banks, empowering them and encouraging them to do loan modifications and workouts to mitigate stress in commercial real estate debt. Okay. Now, again, not every bank is going to do it, and not every deal is going to have this opportunity or have this come through. But for the by and large, and I know people that are in some deals, and I'm in some deals where we're actively discussing successfully. Apparently, they're not completed yet, but there are loan discussions happening all across the country, from mom and pop operators all the way up to the biggest institutions, happening right now, okay, on existing debt. So what does Brad see for 2024? How's everyone doing so far? We'll do Q&A at the end. How's everyone doing so far? If you're hanging with me, type in, I'm in there. I'm hanging with you, Brad. How's everyone doing? Okay, I'm going to wet my whistle here. All right. Okay, good. We're on track. I'm gonna go past the hour. Okay, I'm probably gonna need another 30 minutes. Are we good for if I go another 30? I usually like to finish in an hour, but are we good if I go another, just say to 8:20? Are we good for me to go to 8:20? Tell me if you're good for 8:20, type in 8:20. Okay. Okay, good, because I'm just getting started. I'm really just getting started. Okay, I hope you are too. So what do I see? Okay, well, I mentioned this already. We're at an all-time high affordability gap. And what that means is the orange curve shows the average rent for an apartment building. Now, don't quote me on it. It's either average or median. Maybe it's median. Okay, but it's an indication of a typical apartment. The rent is $1,824 a month. And I think it's median. But the median priced home, that monthly payment is $3,115. That's almost $1,300 difference. Now, for a family making 40, 50, 60,000 a year, that's a big gap. It's a big gap. And so this is why housing is outperforming most other commercial real estate. Okay. So let's look at that. Yeah, here's the chart that says affordability gap reaches all-time high. So just read that, and I'll just read some of the highlights. Higher sales prices, elevated mortgage rates have pushed the affordability gap to renting up to its highest margin ever. The difference between the higher cost of a mortgage payment, its median on a median price single-family home, and the mean apartment rent has ascended to over $1,200 a month. But there are some markets where it's like $10,000, like markets that I don't invest in, like New York and San Francisco, because they're not part of my formula, which I'll tell you what my formula is. But there's a lot of markets where it's much higher than 1,300. So I like to identify some of those markets and stack the odds in my favor by focusing on markets that have higher affordability gaps. If you're following me, hopefully you are. Okay. So what is the forecast for the future? Well, this chart shows vacancy going down over the years. It shows deliveries and absorption. So deliveries are the blue columns, and you can see the number of new units coming online each year is going to decline until 2026, according to this projection. And the units absorbed is going to be higher than the units coming online again in the next few years. So there's a shortage of housing, and especially the B and C, because most of the new units coming online are Class A. So I'm very bullish on B and C because the affordability gap is so high, and working class people are priced out of buying single family homes, and they can't afford the Class A's that are coming on. They can't. A family of four making $50,000 a year is not going to go move into central business district and pay, $2,000, $3,000, $4,000, $5,000 a month for a high-end apartment. Okay, it's too expensive. So this shows the vacancy rate by property class, and it just shows the Class A versus Class B. So Class A is the blue, and Class B is the orange. And so you can see the Class B, and if they showed Class C on here, the Class C would be even lower than the Class B. No, I'm not saying C is better, because if there's truly a recession where unemployment goes up and all that, the working class people get hit really hard. Okay, but that hasn't happened yet to the fear that people thought it might, and it may not happen, and it may, like, we don't know. Okay, but employment's still really strong, and unemployment is still relatively low. Okay, so I'm just speaking what I believe to be true. So based on the research that I've got, if we look at rent growth, we're back in a positive rent growth environment. Like, we could see what happened. Look at the rent growth in 2021. Nationally, it was over 10% in 2021 and 2022. And then it went down, and we heard about negative rent growth, but what we really meant to say, or what they really meant to say, was the rate at which rent is growing, it was declining. Now, there are some markets that actually have negative rent growth, but nationally, the rent growth has remained positive, but the rate has declined down in 2023. But we see, especially in the starting in the second quarter of 2024, we see rent growth coming back up again. And by the end of the year, it's going to be over 3% projected. And then we have 2 years of close to 4%. Okay. So rent growth is back. It's just going to take a little longer to get there. Now, here's why that matters. Let's say we buy a $10 million property and the rents are $1,000 a month. Okay. And then in 5 years, rents go up 3% a year. So that $1,000 a month, 5 years from now, is now $1,160. And so that's $160 a month times 12 months times 100 units. That's an extra $192,000 in cash flow. That's more than I ever made in corporate America. And if you divide it by a cap rate of 5.5%, that's 3.5 million. Now, I never made 3.5 million in 5 years in corporate America, but this is an example, a simple example, simplified example. We're not including costs, inflation, lots of other variables, but a simplified example to just show you how a 3% rent increase over time could make a big difference in property value. Does everybody see that? If you see that, type in, I see it, Brad. Type in, I see it. Awesome. I love it. Thank you. I love when you guys participate. It makes it more fun for me. Now, what are we looking at for sales price? I mean, sales volume and price per unit. Again, I talked about sales volume. Look at 2023. It really went down. Okay, it went down a lot. Look at the end of 2021. It was amazing. It was incredible, the sales volume. So some of you got into the business in 2021 and 2022, and then again, you had difficulty finding deals. But what's happening is that we're kind of coming into a more stable pre-pandemic situation in terms of transaction volume. And according to this forecast, again, according to this forecast, we're at 5, 6, or 7. They're showing maybe a little bit more price dip in 2024. But it also shows price rising in 2024 and going back up, okay, which supports we're somewhere in that 5, 6, or 7 period right now. Interest rates, okay, I attended a presentation the other day and I got this slide. So they say that the summary of economic projections shows the Fed funds rate falling 0.75 of a point by the end of 2024 and down to 3.6% by 2025. So they're saying that there could be substantial cuts in the next 2 years, okay? And there was not one Fed official in this article that actually sees higher rates, okay? So the projections for the FOMC, which is the organization that met today and kept things steady, is to see about 75 basis points in 2024 and then additional cuts in 2025, okay? So that's what we're looking at. And here's another chart. This looks complicated, but if I could bring your attention to the chart in the lower left-hand column, we could see the meeting dates. Today was 1/31. And if we look at the current Fed rate is 525 to 550 basis points. And so there was a 93% chance that that was going to stay unchanged. And that's what happened. It didn't change. There was a 6.7% chance that they were going to lower it 25 basis points. So what this means is the next FOMC meeting on March 20th, the current forecast is there's a 76% chance of them cutting rates in March, a 69% chance of them cutting rates in May, a 56% chance of them cutting rates in June, a 55% chance of them cutting rates in July, a 55% chance of cutting rates in September, a 45% chance cutting rates in November, and a 40% chance of cutting rates in December. And so you could see the forecast and the percentages of where these rates might end up, okay? And the table on the right shows what it would cost today to buy a 1-year rate cap at a 2% rate cap on a $10 million loan. So for those of you that are in variable rate loans that need to buy rate caps this year, you can find this online, okay? You can find these calculators online. And the thing is interest rates go down, the cost to buy these rate caps go down. So I know people that have rate caps that they have to buy this year. And the good news is that the price of those rate caps should be coming down as the year progresses. Okay, so that's another part of my forecast. So what could we expect? Okay, one thing we could expect in 2024, by the way, in 2023, a lot of trades, 40% happened in smaller markets. We call those tertiary markets. I bought a deal in Abilene in December, 280 some units in Abilene. And we were able to get better yield there. So the deal is projected to cash flow like 7 or 8% in year one, which is a pretty good yield. And it's out of the gate. It's out of the gate. But I had to go to Abilene to get that type of yield. Okay. So I would expect the trend to continue to look in smaller markets for better yield. That's number one. One of the concerns we've battled is rising costs, and not just interest rates. Insurance costs have gone up a lot, caused by a lot of natural disasters. Higher property values means higher insurance coverage to insure the value of your property. And so over the last 5 years, property taxes have gone up a lot. Okay. I mean, insurance has gone up a lot, and so have taxes. Now, the other thing that happened is that we call this the generation gap. And a lot of investors came into the market, with interest rates so low, like the 10-year treasury at 2.5% and rent growth at 5%. And some people thought that was the norm, and it's not. And so what we're looking at going forward is more of a return to the norm, with rent growth in that 2 to 4% range and 10-year treasuries around 5.5%, which is more of a historical number. Okay, that's what we're looking at probably in the next year or two. I already talked about FDIC guidance, giving banks guidance to do loan modifications. Only less than 2% of multifamily deals have fallen into the stress category. And this last comment about construction pipeline, we're just going to see less and less new units coming online. Okay, that's what we're going to see. So in my own words, this is what I'm telling my students. This is what I'm telling you. This is what I'm telling my students in my mentoring programs. If you want higher yield, go to smaller markets. The other thing I haven't talked about, value add is back. Okay, there was a time where the cap rates between A, Bs, and Cs got so compressed that so many people just said, hey, if the cap rate for a C class is 4.5 and I could get an A for 4 cap, I might as well buy the A. But now the cap rate ranges of, between A's, B's, and C's has spread out again. And some people talk about negative leverage. Negative leverage is when, let's say you're buying a deal at a 5% cap rate, but you're getting a 6% loan. That's when the rate of your loan is higher than your cap rate, it's negative leverage. But how do you make a negative leverage deal work? Is you buy a value add. You buy something that's underoccupied, the rents are too low, it needs capital improvement, and you buy it based on what you could do with the property. And we're seeing this happen right now. Some of the biggest, most sophisticated investor groups that abandoned value add are now coming back into the value add strategy. Okay. And some of these people are my mentors, and I watch what some of these people do. And that's one of the keys to success, is no matter where you're at, there's always somebody smarter than you, bigger than you, and better than you. And you want to learn from these people. And I have those people in my life. Okay. So I like to tell you what they're doing so that we can learn from them as well. Number 3, we're going to see some distressed deals, but I wouldn't anticipate a huge, amount of them based on what we're seeing right now. Number 4, we're going to return to historical norms. In 2021, anything post-pandemic is not historical. It was either rapidly rising rents and property values or rapidly rising interest rates and low and expensive debt and low transactions. Like the market completely shifted. It went from the most transaction volume we've ever had, or at least in many, many years, as I showed on the last chart, at the end of 21 and 2022, we had more apartments changing hands than virtually any other time before. And in a very short amount of time, it screeched to a halt where we've had the least number of transactions since 2014. So now we're going to see a return, or what I believe we're going to see is a return to more normalcy prior to the pandemic. And then the fifth thing is, I said this before, we're near the bottom. I don't know where we're at, but I believe we're somewhere in that 5 to 7 o'clock period. Okay. So now what could go wrong? And first of all, I'm not saying I'm going to be right. I'm just telling you what I believe. But there's a lot of things that could go wrong. Okay. And this chart shows, the likelihood of the risk versus the severity of the risk. So like a student loan distress could be very likely, but it's lower severity. But having NATO dragged into the Russian-Ukraine war might not be that likely, but it would be very severe globally. And so you could see there's a lot of political events, pandemics, AI, cyber attacks, regional military confrontations, bank failures, government shutdowns, oil prices. These things happen. They do, not all at the same time, and they don't always happen, but sometimes the unexpected happens. And I think that's part of being a sophisticated, educated investor, is knowing that there's always some sort of risk in anything that you do. There's risk if you leave your money in the bank with certain banks, and we don't know which ones those are going to be. And there's risks if you put money in crypto or the stock market. And there's risks if you put your money in real estate. And some of you have experienced those. But I could also tell you that I've been doing this for 22 years, and I still haven't found over time, a more predictable, reliable way to increase your net worth, get cash flow, and reduce your taxes. And that's why I keep doing it. And I'll just say it again. That's why I keep doing it, is because it works. It's not always perfect. We're subject to market cycles, but it works, and it's going to continue to work, and I'm going to keep doing it. And I'm optimistic about 2024 because I see where I believe what I shared with you to be true about where we are in the market cycle. Okay. So I want to talk about top markets. Who wants to know my top 10 markets? Type in top 10. Type in top 10. Okay, let's go. So before I do that, I want to teach you and review with you, those that I've taught this before, what are the criteria to make a market an amazing market? And these criteria haven't changed. It's the same criteria that I did in 2006, 2013, and 2023, and today in 2024. How many 20s did I say? 2020, 2024. 2024. Okay, and these are not in order of priority, but they're all important. Number one, you need to be in a landlord and business-friendly environment. Number two, you want to have job growth above the U.S. average. Number three, you want to have population growth above the U.S. average. Number four, we want to have other key performance indicators like rent growth and occupancy above the U.S. average. And number five, we want to have affordability gap, what? Above the U.S. average. Now, sometimes there'll be a really good market that might not meet every one of these, but it's going to meet the majority of them. But if you're in a market that doesn't meet the majority of these, yes, you could still make money, but you're just going to have more challenges. You're going to have more wind blowing at your face than at your back. We call it headwind versus tailwind. And so if you want to be in a market that has more tailwind, then type in the word tailwind and continue to listen to what I have to say, because that's what I want. I want to be in markets that have more tailwind than headwinds. Okay. Yes. Tailwinds. I love it. So I talked about affordability gap, but where's the affordability gap the biggest? Well, the darker the circle, the higher the affordability gap. So we could see some of these markets aren't very landlord and business friendly, but some are. So like what I'm looking for here is like, just remember the average is 1,300, 1,291. So if you look in the lower left-hand corner, anything orange, red, or whatever that color is, dark burgundy or red, whatever that color is, beyond red, those three colors, orange, red, and burgundy brown or burgundy red, all have affordability gaps higher than the average. Okay. And then some of them are landlord and business friendly, like, Dallas, Houston, Denver, Phoenix, Tucson, Vegas, Reno, Orlando, Tampa, Miami, Fort Lauderdale, West Palm Beach. Now, if we look at the population growth, Texas led the U.S. in population growth in 2022 and 2023. Florida was second. It's no surprise that some of the top markets are in Florida and Texas. Now, if we look at young adult population growth, why do some people look at young adults? Well, young adults are more likely to be renters. So young adults, we could see anything in green is population growth above 3% for young adults. So that population growth segment is going to be more likely than the average population to be renters. Okay. Employment growth. Number one since 2020, Dallas-Fort Worth. Dallas-Fort Worth. By a long shot. By a long shot. Okay. And nominal change. Now, some of the other ones are still very strong, that are landlord friendly. We look at Atlanta, Houston, Austin, South Florida, Phoenix. Okay. Unemployment. So we looked at employment growth, but now we're going to look at the opposite, not the opposite. Instead of employment growth rate, we're going to look at unemployment. So again, that dotted line is the average. So here we prefer markets that are below the average. Okay. We prefer markets that are below the average. And if we look at markets that have had the highest rent growth from 2019 to 2023, we can look all the way on the right-hand side to see some of the markets that have had the fastest rent growth. Okay. So these are the things I look at: population growth, rent growth, affordability gap. Not to be political, but if you want to know if a state is landlord and business friendly, just look at the politics map, red and blue states. It's not 100% accurate. It's not always best to be in a red state versus a blue, but if you want to know if your state government is going to be contesting things that the cities are doing, like Texas is a red state, but a lot of the big cities like Dallas and Houston are ruled by what is commonly referred to as blue. But there was a lot of legal battles between them. A lot of the things the city governments did, the state fought against, and over time became successful. Okay, so that mattered. That mattered to us. Okay, so these are my top 10 markets, ladies and gentlemen, for 2024. And what I've done is I've looked at other reports and forecasts, and then I took my own formulas of the things I share with you: landlord, business friendly, job growth, population growth, affordability gap. And I put together my top 10 markets for 2024. And number 1 is Dallas. Number 2 is Tampa. Number 3 is Houston. Number 4 is South Florida. And South Florida consists of Miami, Palm Beach, Fort Lauderdale, one of the fastest growing areas. Number 5, Salt Lake City. Number 6, Charlotte. Number 7, Vegas. Number 8, Raleigh. Number 9 and number 1 in the Midwest, and number 9 nationally is Indianapolis, and number 10, Nashville. Yes, Nashville, even though Nashville had a lot of new supply coming on in Class A, still a growing market. So I want to show you a couple of the top ones. So this is Dallas. Okay. And I'm not going to read through every chart and graph, but I'm going to bring your attention to the left. So Dallas, DFW, by the way, has projected employment growth of 3%. 3%. Okay. So from 2020 to 2023, it says DFW added 306,000 more positions than the next closest US market. And that lead is going to stretch out even more. And so Dallas is projected to add 374,000 more jobs than the number 2 market for job growth. Okay. So we do have 44,000 new units under construction, but that's a very small percentage represented, compared to the total inventory. Okay. Vacancy is scheduled to go up 0.4% or 40 basis points and that's going to be mostly in Class A, because of new units coming online. But rent growth in DFW is projected to be just about 3% this year at 2.9%. Okay. So Dallas is number 1. Now, if we look at a market like Tampa, I won't spend as much time, or you can take screenshots of these. Tampa has 1.1% employment growth. They have 10 bips or 0.1% vacancy growth. They're going to have, they have new supply coming in, but they have a lot of people moving there. But because of the new supply, they'll still have slight increase of vacancy, but it's going to be around 6.8%, which is well below the national average. And we have rents going up at 3.2% in Tampa. I own deals in Dallas and Tampa, by the way. Dallas and Tampa have been top 5 for the last 5 to 6 years. And they're number 1 and 2 this year. Houston, I have number 3. Okay, Houston, again, employment up 1.8%. Vacancy just a tad up, same reason. There's new inventory coming online, but there's a lot of people moving there. Okay. And rent up 2.5%. So Houston is positioned to be strong in 2024. Number 4 is South Florida, but it's 3 markets: Palm Beach, Lauderdale, and Miami. And so I wasn't able to put them all together on one chart, but it is number 4. But I wanted to show you number 5, my number 5 market, Salt Lake City. 2% employment growth, 2% rent growth. Okay. So that's just a snapshot of top 5 and what makes markets tick. All right. So how many people are going to be looking at these top markets? If you're going to be looking at these top markets, type in, I'm looking. Or which market do you prefer? That's a better one. Which of the top 10 markets are you focused on in 2024? I love it. Now, there's a few markets that dropped off my list, and I got to tell you this, and this might make me unpopular, but I've never been in the popularity business. Now, I do like people to like me, but more than that, I like to shoot straight. Okay. So a lot of these markets have been on my top 10 list for several years, but this year they fell off. So Orlando fell off because the vacancies are higher than the average and rents are actually declining. So that's why I don't have Orlando on this year. Maybe it'll be back next year. Jacksonville fell off because the vacancies are high and we have continued high deliveries with not enough population growth to support it. Denver fell off my list because the vacancies are high and we have low employment growth there. Now, I'm not saying you can't find good deals in secondary markets. I had a deal in Colorado Springs. So just because they're not on the top 10 list, look, at the end of the day, all real estate is local. If you're a local expert in any of these markets, I mean, I know people that are making money in markets that I would never invest in. There's people making money in Baltimore, Pittsburgh, New York. I mean, people own buildings there, Los Angeles. It's just, I don't go there because it violates my guidelines of landlord and business friendly. Okay. Phoenix fell off my list. Phoenix has been on my list for a decade and it fell off my list because of, high vacancy, declining rents, high inventory. Same with Atlanta. It fell off my list this year. I'm not saying you can't make money there, but it fell off my top 10 list this year because of declining rents, high vacancy, high inventory. So just wanted to point that out. Now, there's one other thing I wanted to talk about is like, what do we do? So now we have this information, but how many of you want to win? If you want to win, type in win, W-I-N. Okay. So I've been winning for a while, been winning with apartments for 22 years. And that's not to say I haven't had challenges. And it's not to say I don't have a handful of challenges now. I'm in 27 deals right now. And, there's, less than a handful that are challenged, but I have some challenges. Okay. Everybody that's in the business the last couple of years has some challenges. But the question is, are you just going to, you all got to focus on the challenges and do your best to get through them and fix the problems and fund the deals and tighten up management, and get through it. Okay. But I've been winning for a long time. And in spite of the challenges some of you are facing, you could win too. Okay. And so how do we win? Well, now more than ever, we need to do a couple of things. One is we need to be in the best markets. And I showed you an indication of what I believe to be my top 10, but I also gave you a formula. Okay. So you got to be in the best markets. Number two, you got to form the best teams. Now by teams, I mean, if you're going to have co-investors, co-general partners, they need to be people like, and trust. They need to be people that are in alignment with you. People have been known to get into deals with people they barely know. And then after the fact, when it's too late, they have challenges with their partnership, not to mention even the deal. But if you have a challenge in a deal like rising costs or rising interest rates, and then the leadership team or the GP team is not in alignment, it makes it 5 times harder to fix the problem. So you got to have the best teams, people you invest with, passive investors. You got to make sure your GPs are in alignment. GPs, you got to make sure all in alignment. You got to have the best management companies, the best service providers, the best insurance, the best attorneys, the best people fighting for your tax values. Okay, you got to work with the best people. It's a team sport. One thing I'm doing this year that I would want to share with you is now is a great time to focus on the basic fundamentals. If you've made things too complicated, simplify it. Okay. If you do really big deals with complex capital stacks, do smaller deals with more simple capital stacks. As an example, and I'll talk about some other examples. And number 4, always, always, always be a student. Keep investing in yourself. I mean, that's one of the things that I'm religious about. I went to an alternative investment conference. I'm going to Tony Robbins next week to his Platinum Finance event where he brings in 7 billionaires. And we're going to talk about the state of the financial markets, debt, private equity, alternative investing, global economy. I'm going there to learn. I'm not speaking at that event. This is no OPS for me, if you know what I mean, other people's stages. I'm going as a student. If you stop being a student, you're going to stop learning and growing. So always invest in yourself. And if you haven't made an investment in yourself, that's the best investment you can make, better than multifamily or better than any asset, is the investment you make in yourself. Okay. So what do I mean when I say focus on basic fundamentals? Well, here's what I mean. You got to understand things. And some of you have invested without understanding what you're invested in. Like if you don't understand cap rate, NOI, vacancy, operating expenses, operating income, net rental income, gross rental income, if you can't read a 5-year projection and understand it and know if it makes sense, you have no business investing. And I'm passionate about that. So you got to understand the fundamentals. And how do you understand that? Is you get educated. Okay. Now you got to know how to find deals. And by the way, to me, getting back to the basics is do smaller deals. Now I am not a proponent. I'm not telling you to do a 4-plex and an 8-plex. I've always taught my students the benefits of going bigger and doing 60 plus units, but some of you got too big. You took what I said out of context and you did 500 units or 5,000, tried to do 1,000 unit portfolio when you weren't maybe ready. But when money was easy and debt was easy to get and capital was easy to raise, you could close that type of deal. And so, my advice to you is if you were looking at $30 million deals, look at 15. If you were looking at $40 million deals, look at 20. If you were looking at $20 million deals, look at 10. Okay, there are deals out there. So that's what I'm going to be doing. I'm going to be looking at deals that are a little smaller in 2024. I'm going to be looking at deals that are going to provide me yield. I might be looking in secondary markets. You got to learn how to underwrite deals when you find them. You got to know the fundamentals. Underwriting is a fancy term for like financial modeling. You got to know how to do that. You got to have the tools and the strategies and the training. And you got to manage the deals. You got to actively, proactively manage the management company and work with them and coordinate with them and at times oversee them and at times let them do their job and not meddle. But you got to be in sync with these management companies and get a rhythm and look at the key performance indicators. And there's no substitute to surrounding yourself with people that are more experienced than you and smarter than you on your teams. Okay. So this is so important. And by the way, these were always important, but some of us, got away from it. So how do you invest in yourself? Well, number one, you got to get educated. I don't want to say you gotta, but that's how I started. I went to a seminar. Okay. I attended events. I attended weekend trainings. I joined communities. I built networks, and I got to know service providers and management companies and investors. I got a mentor and I took action. Okay. All the education in the world and all the research and all the studying and all your network and all your team doesn't do any good if you don't take action. But you can't just take action. You got to take the right action in the right direction. So if I want to see the sunset's in the west. And if I take massive action to the east, I am never going to see the sunset. Okay, so you need to take massive action and get educated, but you got to go in the right direction. And that's where education, events, mentorship comes in. Let's see, we'll remove spotlight here. And if there's any questions, I'll take a few questions, 4 or 5 questions. So you could virtually raise your hand and someone on my team could unmute you. Any questions? Any questions about the events? What I cover? All my events. Here's a question I got. Yes, somebody typed in, do I have a mentorship program? Absolutely. By the way, if I wasn't even going to talk about it, but if you're interested in the mentorship program, which I have, and I have hundreds of students, successful students in that program, and you would like for somebody to contact you about it, type in mentorship. Just type in mentorship. So Oswaldo asked the question, anybody interested in mentorship, type in mentorship. So somebody on my team will take a note. We won't have those discussions tonight, and we will just create some space to have that one-on-one with you at your convenience and at our, availability. Okay. So, all right, guys, it's been great. Okay, I see a question from Hong Zhu. Hong, I'm going to unmute you. Hi, how you doing? Where are you from?
Hi, Brad. I'm from Dallas. Thank you so much for hosting the event here. My question is, you talked about your favorite markets. What about those market maybe not that great, lower, I see you listed as a lower population growth for the younger generation, but they have a good cash flow. Is it still worthwhile? Because looking for a good cash flow property in Dallas area is pretty hard now.
Well, yeah, like here's an example. I shared with you, I bought a deal in Abilene. Now, let me tell you something. I've never been to Abilene in my life before I decided to get into this deal. Some of my students have deals in Abilene. A guy on my team has 5 deals in Abilene. So I'm not intimately familiar with it, but because I have a network of people that I trust, my teammate Nick has 5 deals there. And so when I was looking at this deal in Abilene, I called Nick, and he told me, he's like, man, all my deals are crushing it. They're all exceeding projections. I love the market. They're all over 95% occupancy. So before I invested in the deal, I drove out there from Dallas. It's 3 hours away. And I spent 3 hours there, 3 hours on the way home, and I spent 5 hours in Abilene. And I went and looked at like 6 or 7 properties. And I drove around the area, and then I looked at the subject property, and I toured it, and I created the vision for it. And I'm not the only investor in that deal. I'm not the only GP. So I'm part of a team of GPs, but I leverage somebody else's market knowledge and insight. So even though Abilene doesn't have like the most tremendous job growth and the most tremendous population growth, what I learned about it is it's very stable. It doesn't have as many peaks or valleys, and it provides like a 7 to 8% cash flow out of the gate because we assumed a fixed rate loan at 4.2%. So my answer, Hong, is that you're like, look, the top 10 markets are just an indication of like where all the growth and jobs are happening, but in no way, shape, or form, should you, those are all great markets to look at, but it's possible and probable that you'll find other good markets and other good deals too.
Thank you.
Yeah. And that, I've, just to keep going on, I mean, I've invested, I have a great deal in Columbus, Ohio that I've had for, 10 years. I had a deal in Colorado Springs, which was never in my top 10, but Denver was. So another indication, Hong and everybody else, is like Texas is a great market. It's landlord friendly, it's business friendly. Most of the job growth is happen in Dallas, Houston, Austin, San Antonio, but some of the smaller markets get growth too. So yeah. Now, and I'll keep talking as long as all of you keep listening. A couple of things I don't like. I don't like markets or towns that are highly dependent on like 1 or 2 employers. like a town that might have a disproportionate number of employees, like at the chicken factory or at the General Mills plant. And if that plant closes, or if that military base is shut down by the next president, that it would be a suffering blow to the economy. So even if I go to a smaller market, I like markets that have diversification in their economic base and their employer base. That makes sense. Aneet Patel has a question.
Hi, Brad. Thanks for the information. So I have a question. I have a couple of apartment buildings that have 50% loan to value, and they have low interest rates in the threes. And so I don't want to refinance and get rid of that 3% rate of that loan. So I'm trying to find like a line of equity for the remainder of the, to try to take money out, but I'm having a difficult time doing that. What do you recommend?
What type of loan is it? Is it like a government agency loan, or
No, it's a commercial loan. It's a 10-unit building. I mean, I guess I could refinance the whole thing and pay a higher interest rate.
Yeah, but right now,
like a way of doing it where, I don't have to give up that 3% loan.
Well, I would check with your lender and your loan documents, because some of them will allow you to get supplemental loan proceeds on top. You could keep your existing loan in place and maybe get an additional loan at a higher rate with keeping that existing loan in place, but you got to check with your current lender on that.
And who would the supplemental loan come from? The same bank, or do you think?
Well, it could be, yeah, like with government agencies, like if you have a Fannie Mae loan, they will give you a supplemental loan. So you could have like your first loan could be at 4% and your second loan could be at 6%, because your second loan is going to be whatever the current rate is, and your original loan is going to be whatever it was originated at.
Got it. All right.
But I have not done that. So like, I would just say, check with your lender, or get with like get with somebody that specializes in commercial mortgages. Okay. And you would want to have that person on your team, like a commercial loan broker that is really versed in all of those nuances.
Yeah. I mean, I guess instinctively, I'm thinking if I can't get a line of equity, that if I'm trying to grow my portfolio, it's still probably better to sell the property, take out the equity, and buy a larger property, even though it's at a bigger interest rate. Would you agree with that, or?
Well, yeah, because, well, I don't want to just say yeah, but it depends on what your goals are. So, the current property you have with a 50% loan, you got to ask yourself, well, what's your return? What's your cash return? And then what good is that 50% equity doing for you? But if you could put that equity to play into a bigger deal where you have more economies of scale, your nominal cash return might be higher, especially now if we're coming into, a market condition of like level 5, 6, or 7 on the clock, where you could come in and get, a good deal and ride the next wave. And I'm not saying that's something that you could always predict, but,
Yeah, no, great. That's good. Thank you.
Like that opportunity is presenting itself.
Yeah, appreciate it.
Yeah. All right. Well, I don't see any other questions. So I'm going to say good night to everybody. I'm not going to say goodbye, because I don't believe this is the last time we'll be seeing each other. The fact that you're still here, you're in the minority, because most people by now have already dropped off. So for those of you still listening, I don't think it's the last time we'll see each other. So I'm not going to say goodbye, but I'm going to say until next time and good night. So I'll see you, everybody.